What if I told you there's an AI stock flying under the radar, up nearly 50% in the last few months, and backed by NVIDIA? Well, meet Nebius Group, the rising star in AI infrastructure. But there's a catch. Trump's new tariffs could shake things up right before their big earnings call. So, is Nebius about to skyrocket or crash? Let's break it all down. Nebius Group, trading under NBIS, has been on a tear lately. This European AI cloud company specializes in cutting-edge GPU-powered AI infrastructure, making it a direct competitor to the likes of Amazon AWS, Google Cloud, and Microsoft Azure. Founded in mid-2024 after spinning off from its Russian parent, Nebius quickly grabbed attention with massive investments into AI, securing a $700 million funding round led by NVIDIA and Accel. In just the last few months, Nebius hit a new 52-week high at $45.10, up over 40% since December. They recently introduced Nebius AI Studio, an inference-as-a-service platform aimed at making AI model deployment cheaper and faster than competitors. This has drawn serious attention from big tech buyers. And let's not forget Avreed, Nebius's self-driving division, which is now working with Uber on autonomous vehicle technology. So, Nebius is making big moves. But there's one major concern looming. President Trump's new tariff policies could hit the tech industry hard. While we don't know the exact impact on Nebius yet, here's what we do know. Analysts predict these tariffs could increase costs on AI chips and data center hardware, which is crucial for a company like Nebius that depends on high-end GPUs. Since Nebius relies heavily on NVIDIA GPUs, import restrictions could increase hardware costs by 10 to 20%, which might lead to higher service prices or lower profit margins. With Trump's tariffs affecting Chinese semiconductor imports, companies like Nebius may shift sourcing from Taiwan, South Korea, or even domestic U.S. fabs. The company is scaling up data centers in Paris, Finland, and the U.S., but if tariffs impact the availability of critical components, there could be delays in their rollout. The Consumer Technology Association warns that these tariffs could shrink consumer tech spending by $143 billion, affecting demand for everything from AI services to cloud storage. Nebius has been rapidly scaling across Europe and the U.S., planning $1 billion in AI infrastructure investments. If tariffs disrupt supply chains, delays and increased costs could follow. So, the big question is, will this impact Nebius's upcoming earnings report? Mark your calendars. February 20th, 2025 is when Nebius drops their Q4 earnings report. Here's what analysts are looking for. Last quarter, Nebius posted $43.3 million, up from $24.9 million. A huge jump. Will that momentum continue? Nebius's revenue jumped 73% quarter over quarter, one of the highest growth rates in the AI cloud space. Despite strong growth, $51.9 million in losses means they are still burning cash fast. Investors will be watching to see if they're moving toward break-even or deeper losses. However, with $2.28 billion in cash reserves, they have a long runway for expansion. Citron Research has set a bullish price target of $60 plus, but if earnings disappoint or if tariffs hit harder than expected, a pullback could happen. High-growth stocks like Nebius can be volatile, so expect price swings before and after earnings. So, what's the final verdict? Is Nebius a buy, hold, or avoid? If Nebius crushes earnings, secures more big AI partnerships, and avoids major tariff impacts, this stock could see another huge leg up. If tariffs raise costs or slow expansion plans, And if the earnings report shows declining revenue growth, we might see a short-term pullback. My take: if you believe in AI infrastructure, this is a company to watch closely. The NVIDIA partnership alone gives them serious credibility in the space. But with tariffs causing uncertainty, earnings will be a make-or-break moment. What do you think? Will Nebius stock explode or stumble? Drop your predictions in the comments. Like, subscribe, and hit the bell so you don't miss our post-earnings breakdown.